All right, folks, welcome back to another weekly Roundup edition of On the Margin. I am joined by my co-host, Mr. Mark Yusko. Mark, how you doing this morning?
I'm doing great, Michael. Happy Friday. Happy Bitcoin Friday. And,
Happy Bitcoin
looking
Friday.
forward to the conversation.
Yeah, me too. So this is a different background for me. I'm actually visiting a friend of mine in Columbus, Ohio. I'm going to a Billy Joel concert out here. Big plans this weekend. It's a little bit of a last minute move, but I'm being hosted very nicely. It was one of those funny stories. Like I'm flying on the plane and I'm like kind of talking to this guy and I was like, so what brings you out to Ohio? And he's like, oh, I'm going to this, I'm surprising my friend. I'm going to a Billy Joel concert out here. I was like, me too. So funny little coincidence there. But
oh, that's so funny.
Right? Like what are the odds?
Love it. We'll love it. And love seeing next gen fans of Billy Joel.
Big
since
fan.
I grew up with Billy Joel. So.
You know, you kind of, my dad played two artists growing up. He played Billy Joel and the Beatles. And you know how you kind of end up loving the music that your parents play? It's just stuck with me. Yeah. One day we'll do karaoke together, Mark.
Awesome.
We'll get some Billy Joel going.
I love karaoke. I have done it at the supreme level in Seoul. So I'm ready anytime.
Well, one day I'll subject you to me singing every word till we didn't start the fire, and then you'll be like, maybe that's too much. That being said, let's just get right into it here with this week's chart. So I thought this one was pretty interesting, actually. So we're looking at real assets versus financial assets going all the way back to 1925. And I think the way to look at this chart is just, as the blue line is kind of ticking up, that's when financial assets look very expensive in comparison to real assets. Sorry, it's the exact opposite. It's when the blue line is ticking down. So basically, we're at this kind of record time when the price of financial assets is extremely, extremely expensive when it comes to the price of real financial assets. So that's or real assets. That's like commodities, real estate, collectibles, etc. What do you make of this chart, Mark?
It's the ultimate condemnation of the fiat fiasco policies that we've been following since 1913. Look, the Fed was created to achieve exactly this, to destroy the value of the dollar and siphon all of the wealth up to the top of the pyramid. That's why we have the greatest wealth and income inequality in the history of mankind right now. And this shows why, right? Paper, right? Which really is an interesting asset because it's not really an asset per se. And as we'll talk about later, it can be wiped out with one stroke of a policy move in terms of the value of those paper stock certificates or claims like bonds. But this is very troubling to me in that, we live in a time of money illusion. Right? We all think things are going well, but it's because we denominate everything in this depreciating asset, the U.S. dollar. And, this is a sad tale, I think, of a country that's kind of lost its way in terms of global financial leadership.
Yeah. We're going to get into this later as well, talking about China. But we had Bill Blaine of Shard Capital on the podcast this week, and he kind of talked about how the price of financial assets does tend to bleed into the real economy. So there was that story kind of earlier this year, Blackrock buying up residential housing in the U.S., right? And that's kind of an interesting way of how the financial economy and the real economy connect, right? Because people actually need to live in homes, right? They serve a very real purpose, but you've got these huge asset managers that are just looking at them as something to own, right? With a risk return profile. So there is this kind of bleed over from rising financial asset prices into the real economy, and that's like one way to look at some of the inflation that we're seeing, I think, right now as well.
Yep.
So
absolutely.
Yeah. This one is pretty wild. This has been getting passed around on Twitter a little bit. So we're looking at the percentage of U.S. high-yield debt with negative real yields. We are sitting at just under 90% of the high-yield debt market is basically you're earning negative real yields on. What do you think about this? This is a pretty historically crazy chart. Anything jump out?
Again, it's another indictment of just the crazy monetary policies that we've been following. Mm-hmm. And this is theft, right? Capitalism doesn't work with negative interest rates. And these are negative real rates. So this is interest rates relative to inflation. But we actually have negative interest rates all over the world, Europe, Japan, where you have to pay to have your money held by a bank, or you have to pay to loan money to people. That is absolutely insane. And it is just a complete indictment of failed policies, failed government policies, and it's kleptocracy, right? This is simply theft from the masses to the few. And it makes my blood boil to think about it and to see it. And then you have this thing that we perpetuate it by the big mutual fund companies have lobbied and paid big money to get the rules set that all of the minions, all of the masses are forced, because they have no other choice but to invest their retirement savings into these assets. And the passive indices have to buy these assets, irregardless of this stupid price chart. No one would buy this, right? There's not anyone, if you thought about it, would buy this asset. But they don't think. They're not allowed to think. They're dumb, and I mean rule-based, but they're dumb idiotic in that nobody does anything about it. And it's literally like the emperor has no clothes. We need a child, or maybe someone who acts like a child like me, to finally say, guys, the emperor has no clothes. Mm-hmm. This is bad. And, I just, it just tells me I need to get more money into digital assets.
Well, what do you think about this kind of idea, right? There's this idea of low interest rates pushing investors out along the risk curve. And when I look at this chart, one of the first things that I think about is just pensions and how they're going to fund themselves. Because, do you kind of subscribe to this idea that, okay, we've got super, super low rates on the 10-year, so investors that were kind of earning that, quote unquote, risk-free rate, they're like, yeah, this isn't gonna cut it anymore. So then they kind of move out. And then sort of the next place that you would move out to is the high yield bond market. But now you're looking at the high yield bond market. It's like, wow, I'm not getting any real yields here either, right? Because inflation is above the nominal rate, the interest rate that I'm getting. So then theoretically they would move further into equities, right? Am I kind of reading that the right way? Do you agree with that whole framework of just low interest rates pushing investors out on that curve?
No, again, it's the plan. It's called financial repression. Again, repression is an evil term, but that's exactly what it is. This is an intentional plan to, as you say, push investors out on the risk curve. And again, that's insane. Investing is about taking intelligent risks that you are compensated for. If you're not compensated for taking risk, you shouldn't take risk. But now we have this thing where, well, if I'm not compensated for taking risk in treasuries, then I'll take risk in high yield or corporate debt. Oh, if I'm not compensated for taking risk there, I'll take it in equity. Well, the equity risk premiums are tiny. So then what do? Well, then I'll lever up. And then what we see is people get in big trouble. And it's sad, and I wish I had a better solution for it. But the solution is a big reset, and that reset has to happen, and we have to depress the prices of these crazily valued assets, and that's going to be painful for people. But look, the government, in their infinite or lack thereof infinite wisdom, has this problem, right? You have all these people, the middle class and the lower classes, that basically have no savings, right? They literally have basically nothing. So they have a little bit of equity in their house, maybe if they own a house, but a lot of them now don't own a house. They have very little, I think average is like $44,000 in their 401k. And so they can't, quote unquote, retire, right? That dream of working for 50 years and then retiring into the sunset and sit on the porch with your wife or husband or whatever, significant other, and spend time together. You just can't do it. You could be a greeter at Walmart until you're 95. And this is a really tough thing because the only chance you have is to inflate the value of those financial assets, back to the last chart. And you're doing that now through illusion, through money illusion. You just weaken the currency and you make people feel wealthy, even though, right, your 401k value goes up, but then you go to a restaurant and you pay $30 for a hamburger. What? Right? You're less well off. And remember, the people at the top are growing richer at a faster rate, and those on fixed income are getting absolutely annihilated. I mean, it's very, very sad. I mean, like cat food sad. Crazy stuff.
It is. It's a disturbing chart for sure. And actually, this one, moving along here is, I think, pretty interesting as well. So this is an aggregation of the G3 credit impulse, and we're tracking this over the Bloomberg Commodity Index. So basically, the idea is that the credit impulse, which is essentially an economy's willingness to spend and engage in economic activity, tends to lead commodity prices by 12 months. So basically, the idea here is that if this pattern holds, there's been a huge drop in the credit impulse. And basically, the question is, are commodities going to follow? And, to echo something that Raoul Paul says over at Real Vision Bunch, is the cure for high prices is high prices. Right?
High prices,
yeah,
absolutely.
Exactly. Right.
And the cure for low prices, low prices. But look, I wrestled in high school, and I talk about this not all the time, but I say it occasionally. What my coach used to say: two things. If you can talk, you can breathe. So when people say, I can't breathe. Look, if you can talk, you can breathe. So shut up and get back to wrestling. But the more important one is where the head goes, the body follows. Mm. So the head has gone down. And look, China started this about a year ago. So look, China is the one that saved the world in 2008 and 9. They're the ones that say it wasn't Greenspan or Bernanke. It was China. They printed $4 trillion. Trillion. 4. And then in 2015-16, they bailed out the commodity markets again. I actually remember the day I was on CNBC and oil hit $26, and everybody said, what's going to happen? I'm like, well, China's going to start buying oil. And sure enough, they started buying lots and lots of oil futures. And now here again, during COVID, China punched $1 trillion plus of credit impulse into the system, and you can see it. But that's gone, right? They have pulled it back. Other countries have followed. Economic growth is faltering. Fiscal stimulus plans are getting reined in. Monetary stimulus, they're talking about tapering, which they'll never do, but they're talking about it, which means they're not going to increase monetary. This is a very disturbing chart if you're an investor, because this means that everything's going down, from commodity prices to housing prices to stock prices. This is going to be a very painful drawdown. Absolutely.
And, it does feel like that that is inevitably coming, right? A tree can't grow to the sky forever. And, I'm not going to do this right now, but for those investors that kind of look at Bitcoin and crypto and say, hey, this is clearly a bubble, just look at this chart. Just pull up a chart of the NASDAQ over the last 10 years and tell me what that looks like, because it's pretty incredible to just check out. Okay, Mark, this is where I'm not sure. Have you been following this whole Evergrand story over in China?
Oh yeah, we were, past tense, short Evergrand. We covered because we don't think they're going to let it go to zero. Although we were talking with a Chinese manager the other day, and just for background, look, we've been China files for a long time. I've been investing in China since 1993. I've been going to China. Although I haven't been there now for 18 months, but I've been going to China every year for 20 plus years. And it was in 3 phases, right? From kind of 95 to 05, there was this phase where we'd give them our money and we'd get to invest in some really cool companies like Cherry Automotive, but the local municipal tax always equaled our profits. So we never made any money, right? They didn't steal our money, but we could never make any money. Then we had a period from 05 to 15 that was just glorious, because we partnered with the sons and daughters of the Politburo. And one of my favorites is this guy who runs a firm called New Horizon. His dad was Wen Jiabo. It turns out when you need a permit to get to create the largest pork producer, magically that permit appears. And we did invest in this company, WH Group, which now owns Smithfield Foods here in North Carolina, which is kind of funny, are the largest pork producer in the world. We made tons of money. So love that period. Since 2015, there's been a new period where those big firms owned by the princelings have gotten too big. All the big pension funds in the U.S. gave them billions of dollars and their returns have gone down. Now it's all about innovation around healthcare, technology, and retail as they migrate from a manufacturing economy to a consumer economy. And 20 years ago, it was all about made in China. We outsourced everything. We outsourced jobs. We outsourced pollution. We just sent everything to China, and in exchange, we got cheap goods. Well, now 750 million people have been pulled out of abject poverty in China, and they want our life, right? They want to be middle class. So they're going to be consumers. They're going to have the greatest consumer economy the world has ever seen over the next 30 years. And now it's about made for China. So this whole trade war 2.0 is just stupid, right? We are fighting a war as if it's 1930, and it's not, right? It's 2021 and about to be 2030. And we should be focusing on making stuff to sell to this massive consumer market. Now, this chart has to do with the bubbles that the Chinese government likes to create historically to enrich a certain number of people. So they have 80,000 people in the party, senators. They have a lot of senators. And those people get grants of land, and then they sell the land in auctions, and they make a bunch of money, and then they develop on the land. And it was actually a really good system for making a reasonable sized number of people really, really, really rich. Problem is, once people get a little rich, they want to be more rich. And so they do more, and they take out bigger loans, and they get themselves into a massive bubble. And one of the things you see on this chart is that impulse that we talked about, right? Every time China has a problem, they have the ability to massively increase the amount of credit. You can see it back in 2009 around the global financial crisis. And you can see another one around there in 2010. And then again in 15, and then the one in 20. And the problem is then they have to reverse it, because if you have unlimited money printing, what happens to your currency? It gets destroyed. Well, strong nations actually want strong currencies. So what's been one of the strongest currencies over the past decade? It's actually the renminbi. Wait a minute. They're currency manipulators. They're weakening their currency. No, actually, they're not. They're strengthening their currency, and we're the ones weakening. We're the currency manipulators. Usually when somebody in government screams at somebody else, they're something, that's what they are, right? When you point a finger, you got three pointing back at you, the whole thing. That's from a song, right?
Yeah, it's called projecting in psychological terms too. It's
there you go.
Yeah, there you go. So yeah, I think this is pretty fascinating. I'm not sure if you know enough about what's going on in Evergrand. Could you give us like a summary there? Because Tyler and I have talked about this in the past. I keep hearing about it. I haven't dug super deep in, but it definitely looks like there's some problems brewing there. So is it just like they're a developer that kind of got over their skis? Is there something more to pay attention to there, or what's your kind of take?
No. I mean, there's lots to pay attention to, and the reality is that this is one of there's probably 4 or 5 really key developers, and again, they're populated at the top by friends of the party, and they had a great run, and they did get out over their skis, and they kind of I don't know, it's not that they defied the higher ups, but they kind of got too rich. And there is an interesting thing. Xi is many things as a leader, but the one thing he is consistent. And once he decides on something, he executes. So and execute is probably the right word. He has decided that certain people were too bad, right? They were abusing the system. And that was his first wave of clearing people out, like Bin, I can't remember that guy's name, the first one that basically got arrested like the day that she got inaugurated. And And over the years, he's kind of cracked down on corruption. You saw the whole thing with Macau and the money laundering. And now these guys, and they're all old guys, who thought they were pretty safe in these real estate developers, are now squarely in the crosshairs. And you can see they're reducing the amount of leverage. And Evergrand in particular just got way over levered. I mean, just beyond, it's almost like what happened to those poor traders we talked about last week on Binance, right? You lever up crypto at 100x and you're shocked that you lose your crypto, right? You're investing in an 80 vol asset with 100 times leverage. You're an idiot. Don't tell me they stole your money. You lost it because you're stupid. Now, there is another view that someone said, well, what if the company making the loans is really evil, that they want you to take the big loan so they can seize the property? That could be part of the story here. But as I said, we were talking to this Chinese manager who we worked with for a long time, has the best track record in China of maybe anyone except Hill House. And even compared to Hill House on the public side, he's probably better. And he said that the equity's done, right? That they are going to wipe out the equity. They're going to restructure the debt. The company's not going to go away. Properties aren't going to go away. The houses aren't going to go away. They're not going to kick people out of their homes. But he did say that this is going to be ugly for the equity holders. So we probably should have stayed short.
Yeah. Well, hindsight's 2020. This is pretty interesting.
Plenty of things to short right now, actually.
Yeah. So this one's pretty interesting. I don't really have much of a take here, but I just think it is kind of interesting to look at it visualized. So the One Belt, One Road initiative is China's kind of massive infrastructure play. And this is basically giving you kind of an idea of what parts of the infrastructure China is investing in and where they're investing it. It's a huge play. And I guess to connect it to something else that I've kind of heard as well is basically this idea that China is this is their kind of way of going almost long commodities and investing in real assets, and kind of in the same way that the U.S. Do you ever read that book, Confessions of an Economic Hitman? Basically, the way we found a way to get the entire world in debt to us. This is China's play at that. So I'm not sure.
Amen. Look, that is exactly the right answer, Michael. Look, what you have here is, I refer to it as hashtag China playing Go. So the rest of the world is arguing about how you set up the checkerboard, right? Oh, this and that, and this tariff and that tariff, and this policy against China, and we're gonna have a meeting in Congress, and we're gonna say China are bad people. We're gonna label them currency manipulators. You guys are playing the wrong game. They're playing Go, and Go is way harder than checkers or chess. And they tell Putin's a grandmaster, and great. These guys are playing a way harder game, and they're playing it way better, and they just think long term. And what I love about this chart is it goes back to China for 1,800 of the last 2,000 years was the center of the universe. Just let that sit for a second, okay? 1,800 of 2,000 years, China was the center of the universe. And the right-hand side of that chart was the nexus of the world. Now, in the middle of the left-hand side of that chart, Greece, right? There's a point in Greece that's called the navel of the world, right? It's literally, I guess, the geographic center of the world. Now, what did China just buy up over the last 3 years? A whole bunch of ports and land and islands in Greece. How did they do that? To your point, they lent them money to bail them out, okay, because they can do that. And then they take the assets when you can't pay them back, because Greece could never pay their debt back, not even close. It's a wonderful place to go vacation, to go hang out, but as far as well-run country, good management, not so much. And it was intentionally destroyed by the Germans. This is a whole other story. The Germans cooked up this idea for the euro, not to make the euro strong, but to make the euro weak, because they are the greatest mercantilists in the world. We think of China as being mercantilist, meaning making stuff and send it to the rest of the world. What does Germany do? They sell cars and machine tools to the rest of the world. How do you do that? You have to have a weak currency. So what you do is you invite all the crappy countries into your currency block, which weakens your currency. So the euro has had this weakening path so that you can sell cheap goods to the world. And if you go to China, most of the cars aren't Chinese cars. They're German cars. Volkswagen, number one. So what's genius about this is the nexus of the world shifted 200 years ago from China to Europe. And Europe had a pretty good run. UK was was the dominant superpower, about a 70-year run. And now, for the last 70-odd years, it's been squarely in the United States. And we were an emerging market from 1776 to about 1910, and since then we've had a pretty good run. And now the nexus is moving back to Asia, and Southeast Asia is pulling it with a gravitational force. And this idea, this Belt and Road Initiative, they used to call it One Belt, One Road, and we actually tried to get the OBOR ticker to do an ETF on this, and then they changed it. Well, now what do I do with OBOR? So now you call it BARI, B-A-R-I. And this Belt and Road Initiative is so important because it does everything that you would want to do if you had grand plans for being the dominant world superpower again. You would establish trade routes and physical routes like roads and ports and bridges and train tracks and everything to the biggest markets, right? You look at Europe as a market and Africa. There's this great cover story, The Economist, a number of years ago, and it was Africa draped in a Chinese flag. Like they had gone in and they'd bought up all the resources and loaned everybody money with this grand plan that when you can't pay us back, we will seize the assets and we will own most of Africa. So this is intentional. It is genius from a long-term planning perspective because you're finding the trading partners that you're going to need as you lift your poor into the middle class and turn them into consumers. They're going to want to buy German cars, and they're going to need raw materials from Africa, and they're going to need, all the fancy things that you can get, Swiss chocolates and all that good stuff. And it is going to reestablish China and other Southeast Asian countries as the nexus of the world for the next century.
Yeah, absolutely. It's really funny. I want to move on to make sure we have enough time for our stories, but you anticipated this great point. I actually heard James Aitken. I don't know if you know him. He made this point on Dimitri's podcast, which is exactly what you just said, which was essentially Germany was trying to punish Greece, right, during that restructuring, and their economy has never really fully recovered because of it. So a lot of questions.
Oh, absolutely. And look, and it's not that it's dire, like it's going to fall into the ocean. People still go there on vacation. I have a good friend who just spent 2 weeks there and loved every minute of it. And he said, these guys know how to do vacation. Like, yeah, that's what they're really good at.
They do. They really do.
Although it's funny. I went to, the big crater island. Not Sardinia. Santorini.
Yeah,
oh, my gosh.
Yeah.
Santorini. Beautiful. Yeah. And first day, oh, my gosh. I never want to leave. Second day, this is really awesome. By the fourth day, I'm like, geez, I'm bored. I mean, staring at the beautiful water and eating unbelievable food and looking at Oya over on the other side, or however you pronounce it, OIA. It's awesome. And taking that little hike along the ridge. But by the fourth day, I'd done it, and I was ready to go.
Yeah. You got to do a little bit of island hopping. You got to get to like Mykonos if you want to do your party.
Yeah,
different.
Well, you can go to Mykonos. I'm old. You can go to Mykonos.
Mark, age is a number. I feel like you could do it in Mykonos. One day we'll go. We'll do something.
All right.
Billy Joel.
You know what? I will take you up on that. I'll hit that bid.
Okay, cool. All right, let's get to this first story here, which is Coinbase the SEC threatening to sue Coinbase over its Lend product. So basically, a whole series of events here. And I think there are pretty broad implications for just how Lend, because yield and Lend is a big product and focus in crypto in general. So there's been a question of how the SEC is going to regulate it. And this doesn't maybe bode super well. But the whole the series of events is that Coinbase announced that it's going to launch a lend product, very similar to kind of BlockFi's product, right? So you get something like 4% on whenever you deposit. The SEC kind of comes out and says, hey, if you guys move forward with launching this product, we are going to sue you. Coinbase then goes back to the SEC and says, could you give me legal ground, or why are we being sued? Yeah. SEC says no. So Brian Armstrong, the CEO over at Coinbase, posts a blog on Twitter, and now it's a lot of like back and forth. And generally, there are kind of two narratives forming, and this is what I want to get your opinion on. One is that this looks very much like a bond, right? Because what you're doing is you're pooling assets. There's a manager that's managing those assets and kind of determining where to allocate them to get yield. Very, in some ways, it looks like an investment contract. On the other hand, you've got this narrative, which is like, look, guys, this actually looks almost more like a bank savings account, right? That's the Matt Levine take, which I really agree with. You haven't provided a framework. There should be a framework to do this. This isn't some illegal product that we're offering here, and you guys just haven't given us a path. So where do you kind of come down on this whole thing? What's your take on the whole situation?
I have really strong opinions, and I have to probably be a little bit careful. Some may or may not know. I mean, we are very significant investors in BlockFi. Mm-hmm. It's been one of our best investments that we've made, and are incredibly supportive of Zach and Flory and the team and everything they're doing and building, and just think they're fantastic. We're also investors in Coinbase, not as big, but certainly investors there, and we still do own the stock. So I haven't sold, and don't want to sell here. Also, investing in Gemini, which has an earn product. So we're all in on this product. And to your point, I have a very strong view. This is not a bond in any way, shape, or form. And trying to make it look like one, you can look, if you torture the data long enough, it will confess. You can make any case you want. By ignoring certain things or saying things that are kind of partly true, fine. You can say, yeah, it kind of looks like a bond. Well, that kind of isn't how the law works. This is the equivalent of a bank deposit. Now, it's even the name, right? BlockFi, blockchain financial. What they're doing is a form of banking. They take deposits, they lend the deposits and pay interest. That's what banks do. But the banks don't want to call it a bank, so you can't call it a bank. So, Caitlin's Avanti isn't called a bank. I mean, actually, I think maybe they did. Maybe they did call it Avanti Bank.
They might, yeah.
Actually, I think
yeah.
They did.
Yeah.
So, but the banks get all up in arms when you call it a bank because I don't know. They don't want to lose their deposits. And so my view on this is up to this point, and we talked about this last time, I think the SEC has been actually really good. Right? I think they've been measured. I think they've been prudent. And most importantly, I think they've been consistent. And that is not necessarily their modus operandi for all of their history. But in this case, around crypto, I think they've been those three things. Now, suddenly, they're being so inconsistent and so opaque. That's not how relationships work. That's not how processes work. And this idea of being totally capricious in saying, well, you, Coinbase, who was actually late to the party on this earn idea, that's wrong. But these other guys who are already there, well, but they're having discussions at the state level and others. So, there's already people questioning whether this is a security or not. And so I have an opinion that, and this is not the opinion of the companies I invest in, but it's my opinion, that this is actually propagated by the banks, right? The banks lobby really hard to whoever, and usually regulators. Remember, incumbents have used regulation as a weapon for centuries, right? That's what every incumbent does, right? They try to stop the disruptive innovation through regulatory hurdles first. It's the old, first they ignore you, or first they laugh at you, then they ignore you, or first they ignore you, then they laugh at you, then they fight you. Okay, fighting is where they put up the regulatory hurdles. And in the end, you do win because this is not a security. Now, I actually think there might be a path where just for, I don't know what you call it, speed of execution's sake, some of these companies just say, you know what, fine, I'll register this product as a security. I don't actually love that necessarily because it sets precedent. On the other hand, I get it as someone who's trying to manage a business and grow a business. If the regulator says this is the way it's got to be, okay, fine. But now, are you gonna then enforce that same action against all banks, right? Or all banks gonna have to be broker dealers to sell securities? I guess the other way you could do it is maybe say, well, these companies just have to get banking licenses. Maybe that would, I don't know. But they're not the same in that we don't view them as currencies. We view them as property. Right? Now, if you want to define it as currency and you want to define it as money, that's a whole nother kettle of fish that we can, or can of worms that we can open up. So it's a complicated issue. I have to tread a little bit lightly because, I'm involved and I don't want to be harmful to anybody who's in this process. Someone asked me the other day, what do I think of Brian, Twitter shaming the SEC? I said, well, probably wouldn't have been my first choice. On the other hand, if you've tried everything else and they won't talk to you, they won't give you a straight answer. They won't give you, there's this thing called, have you ever heard the term niggy sob? All right. Niggy sob stands for now I got you son of a bitch. And the way it works is your significant other says, make me happy. And you go out and you take them to a nice meal. Like, it's not what I wanted. That doesn't make me happy. You say, all right. So you take them to a movie. That's not what I wanted. Now I got you son of a bitch, right? I said, make me happy. And you didn't do what makes me happy. Well, no, tell me what you want and I'll do it. I mean, come on. So when you give a generic goal with no steps to reach that goal, that's a niggy sob. And so I think the SEC is doing the biggest niggy sob of the last decade on businesses that are absolutely essential. I mean, let's go back to the charts we were looking at. The current system isn't working for the masses. It's just not, right? Devaluing the currency that's owned by the masses and that the masses use to live, and so that their standard of living is going down, that ain't working. And so if I want to opt out with a portion of my wealth, deposit it where it can work in the system. Remember, how capitalism works is positive interest rates. I deposit my assets, they lend them out, so they recycle them and use them, right, through, fractional reserve banking, so to speak, which to me is one of the great inventions of our time, used appropriately with prudent limits on how many times you can rehypothecate. But ultimately, now we're in this situation where the incumbents are saying, slow these guys down. Why? If the incumbents were doing their job, we wouldn't need this other stuff.
And I will say about the whole Twitter thing, the SEC, maybe this is just how communication happens in our time, because then the SEC trolled Coinbase right back with a video of how bond works. So maybe this is just 21st century communication. We all need to get used to it.
Yeah, amen. It is certainly possible. Look, we had a seated president who communicated by Twitter until he got banned. We definitely have Twitter fights between all kinds of actors, and I mean active, but all kinds of economic actors in the world. So yeah, you're right. It could be just the form of communication. It is pretty effective because of the viral nature. And given that is the way many of us now consume our information, it's not a bad path.
I will say on this as well, I think there's not too much that's certain in crypto, but one thing that I do think is certain is that regulation is good, but the market thinks that it's bad, and it is going to give us one huge buying opportunity at some point. Everyone is going to freak out about something that looks bad, but it's actually good. And I think this is it. So I know are an investor in Coinbase.
It's such a good point.
If I could be, I would be buying BlockFi with both hands right now. They are good. They are a smart management team. They're going to figure out a way around this. They're not going to make this product illegal. I mean, if I had the ability to do it, I would be buying with both hands. So
yeah. Well, we might be able to help you with that. So
right.
look, no, seriously, I look, you're exactly right. What these companies are doing is good. Full stop.
That's how I view it too.
Allowing people to use their assets, right, that they've earned and gotten, perfectly legally and in every way is positive, to allow them to make them work better. It's like the whole premise of DeFi,
right?
If I can lend peer-to-peer cheaper, more efficiently, more effectively, how is that a bad thing?
Yeah.
It's not. It's all good. But and to your point, regulation is good. Ground rule. Think about raising a child, right? Children want you to set boundaries. They don't want you to say, oh, do whatever you want. Just do whatever you want. They want boundaries. They want guidelines. They want rules. And the thing about regulation, and this, though, I think we might have even talked about this last time, Jay Clayton, right? A lot of things that he did I didn't agree with in terms of not approving an ETF and all this stuff. But the one thing he said that I thought was really powerful, he said, look, our system of regulation has created a financial system that is the envy of the world. Yep, it's true. And trillions and trillions, multiple tens of trillions of dollars of wealth. Yep. So within that framework, we don't have to blow it up. All we have to do is operate within it, but we do need consistency from the regulators, and we need them to be free from bias created by money being paid to them by the incumbents. That's important.
Howdy, everyone. If you're a long-term investor in Ethereum, then listen up because I am talking directly to you here. If you've been listening to the show for the last 2 months, then you know that I am a big fan of ETH and the entire world of DeFi that's being built on top of it. It's honestly just super interesting, but it's also probably the single greatest wealth creation opportunity that I am ever going to see in my entire life. And the best thing about ETH is that you can hold it, but with this new upgrade to 2.0, you can also stake it and earn yield that way. The only problem is, under the current set of rules, unless you have 32 ETH, or at today's price is almost $100,000, then you can't stake it. Until now. Our good friends over at Matrixport just unrolled a solution which allows investors with as few as 5 ETH to start staking today. At the time of this recording, you can earn up to 9% APY, although that's going to vary based on the protocol. So, stop what you're doing, stop listening to me, go click the link at the bottom of this episode. If it's on YouTube or Spotify or Apple or whatever it is, click that link, go over to the website, and tell them that I sent you. All right, give me a little credit, but definitely go click the link, start learning about how you can stake your ETH and earn yield or other yield generation opportunities.
But I do want to get your opinion on this story about George Soros. So George Soros kind of came out and called Blackrock's China investment a tragic mistake. And let me give you kind of a series of events here, because there's been a couple of op-eds that he's wrote, and actually the Chinese state media has responded. So on August 30th, Soros wrote an op-ed in the Financial Times where he basically kind of was looking at some of the regulatory crackdowns that China has been having and saying this is not really great for investors, and Ant Financial is a particularly bad one. The Chinese state media responded and called George Soros a global financial terrorist. George Soros waited a couple days, responded with the most recent op-ed in the Wall Street Journal. And if you read it, it's pretty interesting. He talks about BlackRock and their kind of the mutual fund play that they're making over there. And he basically had two different styles of arguments. One of the layers of argument was the policies that China is undertaking right now are to redistribute wealth to the middle class. That's not going to be good for shareholders. So he kind of had this look, it doesn't make sense on an investment scale. Personally, I think that's really interesting that that's what their stated objective is. We could use some of that over here. But that's his observation. And then he really kind of put a, we're almost like ideologically very opposed. So this is the quote: "Today, the U.S. and China are engaged in a life and death conflict between two systems of governance, repressive and democratic." Right. So there's the investment standpoint, and then there's the ideological battle or ramming up against each other. So what's your kind of take on this whole situation here?
Actually, I have a lot of views on this. So one is I have nothing but admiration and respect for George Soros. I mean, he is a brilliant investor. He has a incredible track record of genuine insight on investing for many decades. So from that perspective, wouldn't want to go toe to toe with George on investing. With some of his other stuff, I probably have less admiration, just because we're all entitled to different views about different things, and again, I don't really want to be on the record disagreeing with him, but I actually do, in that I actually agree with him wholeheartedly that we are locked in a struggle. But I don't think it's between democracy and repression. The idea that we're some lily white democracy and that we're not doing financial repression on our own citizens, that we're not extending the wealth divide, that we're not stealing wealth from the middle class and the poor and siphoning it up to the rich, that's just crazy. I mean, I can show you lots of examples of policies that our government, I mean, look at this whole nonsense about vaccine mandates. And I mean, that is not democratic, right? I saw a great line, and I don't remember who said it. It said, the current administration is all about my body, my choice. Well, except when it comes to putting chemicals that have never been tested in your body, then it's not your choice. Like, oh, that's a really interesting perspective. You can't have it both ways, right? You can't talk one ideal in Texas and another ideal in DC. So, and again, that's not a political statement. That's just an observation that I thought was really interesting. So, look, we have been engaged in Cold War 2.0 for a while. And I believe the reason we've engaged in Cold War 2.0, and we started it, right? People say, oh, China started. No, well, we started it. And we started it because they were ascendant and they have a plan, right? It's like they think in 30-year plans. They think in 100-year plans. And they had a plan for the renminbi to become a world reserve currency. Not the, but a world reserve currency. And we're like, no, we're the world reserve currency. Well, we didn't say we wanted to be the. We said we want to be a. So they did that, right? They achieved that with the SDR inclusion. And we want to be part of WTO. They did that. We want to be the world's manufacturing powerhouse, and they were for 20 years. And did they do lots of things that I don't condone in terms of stealing intellectual property and absolutely, right? They found copies of Cisco routers with the bugs in them, right? So yeah, Huawei 30 years ago, 20 years ago, sure, they did all kinds of bad stuff. Today, accusing Huawei of stealing, I think Huawei actually has more citations for patents on new technology and AI and 5G than we do. So who's stealing from who? And so, again, we're fighting the wrong war, and they are executing at a better clip. So if you look around the world, more countries are choosing Huawei 5G than the U.S., quote-unquote standard.
Also trade partners. There's a great chart circulating out there. Maybe we'll do it on the Roundup next week, but you can look at it's in the year 2000, who the dominant trade partner was, and it's like the United States for the entire world. And if you look now, it's literally only for North America we're more dominant trade partners. Everywhere else in the world, the most dominant trade partner is China. It's an incredible chart. Of course.
Again, we went back to the Belt and Road Initiative. Exactly, Michael. I mean, look, China has a plan. And yeah, does their plan include things that we don't really understand because we do have a different form of government? Yes. We have this representative democracy, although it isn't exactly representative because, remember, they don't have to vote the way the masses vote, and we got these electors, and then they can be changed. And so it's pretty close to representative government. And they do have a centralized authority, but when you have 1.4 billion people, more than half of them living in abject poverty, you can't have a pure democracy, right? You had to have a plan to get to a more democratic society. Now, right, what they're doing right now is they are so first they built up the rich and they brought the poor along with them, right? So they pulled the poor out of abject poverty, but the rich got really, really rich, and they were doing some stuff that, arguably they didn't like. Ant Financial, right? Why did Ant Financial? Ant Financial happened for the same reason that we were just talking about Coinbase is happening, okay? Ant Financial created a money market account that siphoned $90 billion out of the banks. Well, the banks can't afford to have $90 billion siphoned out because they're too highly levered. So they shut it down. And look, there's this great story about Putin saying to the oligarchs in Russia years ago, here's the deal. Bring back the money, put it in the state-owned bank, spare bank, no questions, no taxes, no jail time. Only thing you have to do is not run for politics. Okay? Most of the oligarchs said, awesome. They brought back $300 million. They recapitalized the banking system. Spare bank's been a great investment. Russia's had this ascendant. There was one guy, Khodorkovsky's like, nope, I'm running for office. Where's Khodorkovsky? In jail.
I was going to guess that.
There was one rule. Yeah, there's one rule. All you do is not run for office. But okay, so kind of China said the same thing now to Jack Ma, right? One rule. Don't siphon money out of the banks. Nope, I'm going to take Ant Financial public. We're going to make this thing the biggest money market account in the world. No, you're not. We're going to shut you down. Now, do I agree with that per se? No, I'm an open market capitalist. I think the capitalist system should work. Problem is, in the United States, we don't have capitalism anymore. We have cronyism. And in China, you got cronyism. So the more you move towards capitalism, and I would argue that they are moving more towards it, with the one thing, and I'm torn on this because I love the construct of now they're taxing the super wealthy, successful companies like Tencent and Alibaba, and they're going to create a fund to redistribute to the poor and middle class. And I don't know how I feel about that. I mean, it's the same thing we do, right? We tax people. Well, we don't do the same way. We don't tax the really rich companies because they pay the lobbyists to get them exempted from taxes. So the rest of us, high income earners, pay the taxes, and then we redistribute it out in free handouts to people. I'm not sure that's any different than what China's doing. So this idea of democratic versus repressive, I just don't agree with. And this idea that the CCP is the devil, I don't agree with. What they did with the education companies, I don't like it. I particularly don't like the fact that why would you destroy the equity of companies? Well, let's think about this. Who owned the equity of those companies? Mutual funds, hedge funds, individuals in the United States. Did any of the Chinese venture capitalists own them? Nope, they got out a long time ago. So maybe that was a retaliation for the tariffs and the Cold War 2.0 rhetoric. And so maybe we're just in this hot war. Maybe it's gone from a Cold War to a hot war. And so back to the question on BlackRock. BlackRock doesn't care about anything but making money. And that's a strong statement and probably get in trouble for saying it. But look, they are the ones that created the whole 401k system. Not BlackRock per se, but the mutual fund industry, right? The mutual fund industry created the 401k so that they could all get rich while the average person has no savings. Okay? Bad. Defined benefit was a way better plan than defined contribution, way better for retirees. Defined contribution is good for mutual fund companies. Then BlackRock tried to pass remember the fiduciary law that they were going to try to pass a couple of years ago that Mooch thankfully blocked, right? In his 10 days in office. But he actually convinced them not to pursue it because it's stupid. To say that the lowest fee product is the best is insane. That just meant that everyone had to put money in ETFs. Oh, who are the big ETF companies? BlackRock and Vanguard. Oh, who wrote the legislation? BlackRock and Vanguard. So is BlackRock, can they say we're not going to invest in Chinese companies? No, because they want to get all of that wealth that's being created in China. They want to manage some of it in the equivalent of 401ks. Surprise, surprise. So do I think they are purely economic actors? Yep. Do I actually like economic actors? Yes. Do I think that we collectively need to fight back against China's policies? Yep. How do you fight back? Economically. right? If we all did stop buying Tencent, it actually would matter, right? And so I'd say I have mixed emotions on this. I think it's a really important point. I think it's a really important topic. I think George is mostly right, but as usual, he goes way out on that extreme. And part of that is because it's theater. Part of it is, we're trying to elicit strong emotions, because when you elicit strong emotions, sometimes you get bad decisions. And if you're in a war, you want the other person to make bad decisions, so you bait them. So anyway, we could do a whole session on this.
I was going to say
love
we
this
could.
topic.
I know, me too. But unfortunately, we're running low on time, so we got to wrap it there. I know. Mark, this has been another great...
Well, until we meet again a week from now. This is fun.
I know.
Really enjoy this.
Me too.
And thanks for hosting.
Yeah, it's a blast. All right, I'll see you same time next week. Cheers, my friend.
Yep. Enjoy the concert and have a lot of fun.
I will. Thanks, man. Bye.